Hello and welcome to today's video. In this video, we will discuss the dangers posed by credit default swaps, CDs, to major global banks, such as Deutsche Bank and the Bank of Japan, in light of the global bond market going into a crisis. First, let's start with a quick recap of how CDs works. CDs is a financial contract that acts as insurance against the risk of default on a bond or other debt instrument. Investors who buy CDs pay a premium to the seller, who agrees to compensate them in the event of a default. The premium is typically paid annually, and the amount is based on the perceived risk of the underlying bond. Now, let's move on to why CDs can be dangerous when the bond market is failing. If a large number of bonds begin to default, it can put immense pressure on the sellers of CDs. If too many buyers claim their payouts at once, it can lead to a domino effect of defaults, which can ultimately lead to the collapse of the entire financial system. One of the most well-known examples of this occurred during the 2008 financial crisis. At the time, many banks had been buying and selling CDs, particularly on mortgage-backed securities. When the housing market began to collapse, a large number of these securities began to default. This led to a domino effect, which resulted in the collapse of several major banks, including Lehman Brothers. Now, let's focus on the two major banks that are next on the chopping block, Deutsche Bank and the Bank of Japan. Deutsche Bank has been particularly exposed to CDs, with an estimated $45 trillion in derivatives exposure. This has put the bank in a precarious position, as a significant number of their CDs are on risky debt in emerging markets. If these bonds were to default, it could have severe consequences for the bank. Similarly, the Bank of Japan has a large exposure to CDs, particularly on Japanese government debt. Japan has one of the highest debt to GDP ratios in the world, and if the country were to default on its debt, it could have significant consequences for the global economy. So why are the largest banks the ones most likely to take on the risk of CDs? It's because they know the global reserve banks will view them as too big to fail and will bail them out. This creates a moral hazard, where banks are incentivized to take on excessive risk because they know they will be bailed out if things go wrong. This has significant implications for the global banking industry and the global economy as a whole. If a large number of CDs were to fail, it could lead to the collapse of several major banks, which could trigger a global financial crisis. The consequences of such a crisis could be severe, including widespread job losses, bankruptcies, and even social unrest. In conclusion, the global bond market going into a crisis is a significant threat to major global banks, particularly those that have been exposed to CDs, such as Deutsche Bank and the Bank of Japan. While the global reserve banks may be willing to bail out these banks in the event of a crisis, the moral hazard created by this can lead to excessive risk-taking and ultimately have severe consequences for the global economy. It's essential that regulators take steps to ensure that banks are not taking on excessive risk and that the global financial system is protected from the dangers posed by CDs. Thank you for watching. If you enjoyed this video, please click the like button, subscribe to our channel, and click the bell for notifications of future categories content.